Welcome to the deep dive. Today we're plunging into the often mysterious world of Palantir Technologies, Inc. They're a company that consistently sparks intense discussions, sometimes confusion, and always, well, ton of curiosity. Our mission today is to cut through the noise. We'll be using their 2024 annual report, that's the Form 10K, and their insider trading policy. We want to uncover the really essential insights. Think of it as your shortcut to understanding not just what Palantir does, but maybe why it matters right now.
Exactly. And for you, the learner, the 10K isn't just some dry financial document. It's really a strategic roadmap. It lays bare their operations, their vision, and crucially, the inherent risks they navigate. And the insider trading policy, well, it might seem a bit niche, but it offers crucial insight into their commitment to, market integrity and responsible conduct. So we're here to extract those high-impact takeaways, help you walk away with real clarity without getting bogged down in corporate legalese.
Right. Okay. Let's zoom in on this company then. Palantir, based in Denver, listed on the NASDAQ, ticker PLTR. The name's definitely out there, but what exactly is the core business? What's really driving their growth?
At its heart, Palantir builds and deploys these pretty sophisticated software platforms. They basically act as central operating systems for their customers, helping organizations integrate just vast amounts of data and streamline really complex operations. They built four main platforms: Gotham, Foundry, Apollo, and their newest one, AIP. Gotham, Foundry, Apollo, they provide the foundational infrastructure, data integration, operational support. Apollo is particularly noteworthy. It allows their software to run in, well, they say virtually any environment, which guarantees continuous operation for those really mission-critical systems.
Okay, and then AIP, the new one.
Right, AIP, Artificial Intelligence Platform, launched in 2023. And what's really crucial about AIP is how it combines their existing software with generative AI models, things like large language models, LLMs. But it's designed to uniquely connect these powerful AI tools with a customer-specific data and operational workflows. So it facilitates real-time decision-making, but, and this is key, while adhering to strict legal, ethical, and security boundaries.
And this is where Palantir's distinct advantage seems to really shine, right? You think about those massive, often failed internal software projects, the ones that cost billions, take years. Palantir actually highlights this. They talk about recent global crises like Russia, Ukraine, the Israel conflict, how those situations expose just how critical it is for organizations to move fast, to not get bogged down by, quote, extended timelines. They claim their software can be ready in days. It's just a stark contrast to internal efforts that might take months or years. That seems like a truly unique value proposition, especially in an industry often plagued by delays.
It really is. And what's fascinating here is how that speed, that adaptability is driven by their vertically integrated platforms, which basically means they control the entire software stack, from data coming in right up to the user interface. And this deep control allows for seamless integration and just remarkably faster deployment compared to piecing solutions together. This also empowers users with different technical skills, maybe data engineers, maybe senior leaders, to collaborate effectively. They can integrate trusted data into the business logic and ultimately drive critical decisions faster.
That's quite an ambitious strategy. Definitely sets them apart. Now, let's translate that innovation into tangible results. What do the numbers from 2024 tell us? Their financial health.
Okay. Numbers. Palantir generated just under $2.9 billion in revenue in 2024, but the striking insight isn't just the nearly $2.9 billion figure, it's the split. Almost perfectly 50-50.
Yeah.
55% from government customers, 45% from commercial clients, which reflects, I think, a deliberate strategy to diversify, to grow beyond their foundational government contracts, shows a maturing business model.
Right, moving beyond just government work.
Exactly. Geographically, the U.S. is still their primary market, 66% of revenue, 34% from abroad. And their expanding relationships are pretty clear, too. The average revenue from their top 20 customers, it grew significantly to $64.6 million in 2024. That's up from $54.6 million in 2023. And specifically, their U.S. commercial revenue saw a really robust 54% increase year over year.
Wow, 54%. Okay. It sounds like they actively seek out the most complex, maybe even daunting opportunities. You mentioned they even highlight past failures elsewhere, like a U.S. military department spending over $1 billion on an ERP system. That's enterprise resource planning.
Right.
Basically massive software to manage core business processes, and it was never even delivered. For a company aiming for rapid deployment, doesn't that strategy seem incredibly risky, high potential for failure? Or is there a hidden advantage?
Well, it is risky, but their strategy is indeed very specific. They state, the larger, more complex, and more technologically demanding the problem, the more likely we are to succeed. The hidden advantage, perhaps, is that by solving the hardest problems, they prove their software's unique capabilities where others fail. And that builds immense trust, right? To accelerate customer acquisition, they use several strategies. Their AIP boot camps, for instance. These let them deliver, quote, real workflows on actual customer data in days. It's a rapid demonstration of value.
A try before you buy, almost, but on their real problems.
Sort of, yeah. A very intense trial. It significantly expands their potential customer base. Plus, in 2024, they introduced a developer tier. Offers limited access to Foundry and AIP. Lets developers explore, innovate without huge upfront enterprise costs. And beyond just getting new customers, they focus heavily on account growth. Scaling existing contracts horizontally into new divisions and vertically for more users, often by tackling a customer's most pressing and challenging problems first, again, building that trust. They're even positioning themselves as central operating systems for whole industries, like airlines, insurance, healthcare, automotive.
That's fascinating. Industry-wide platforms. And what about the timing of all this? Do their sales come in evenly through the year, or is there a pattern we should know about?
Which brings us to a crucial point for anyone tracking their performance. Their quarterly results. They often fluctuate. Historically, their first quarter, Q1, typically sees relatively lower sales. Then you see substantial increases during the third and fourth quarters, Q3 and Q4. And this seasonality is directly influenced by fiscal year-end procurement cycles. For government customers, that's September 30th. For many commercial customers, it's December 31st. So a big Q4 push often.
Got it. Okay, that makes sense. Important context for interpreting quarterly reports. Now, this next part feels incredibly important, especially with AI advancing so rapidly. Given how powerful these data platforms are, how does Palantir approach privacy and civil liberties? It's a huge question.
It is. And Palantir emphasizes, quite strongly, a deep commitment to preserving individual rights. They make privacy by design a core principle.
Right.
In their software, in their business practices, they are very clear. They are not in the business of collecting, mining, or selling data. That's a direct quote, almost. Instead, they build platforms that enable their customers to securely integrate and manage data they already possess. Their principles include building in privacy from the ground up, aiming to eliminate those perceived trade-offs between privacy and utility. They firmly believe decisions affecting individual rights cannot be left solely to computers. That's another strong statement. So they design systems where humans retain the ultimate judgment calls.
Human in the loop, essentially.
Exactly. Their platforms facilitate accountability and oversight through usage controls, data handling alerts, comprehensive audit information, and crucially, they state they will turn the opportunity down if they cannot engineer ethically responsible solutions, asserting that, quote, technology is not the answer to every problem.
That's a powerful stance on ethical responsibility. But, given their work with some very sensitive entities, law enforcement, defense, how do they ensure these principles aren't compromised in practice? Are there specific checks and balances beyond just the stated policy?
That's a fair question, and the 10K actually provides several real-world examples. For instance, a major law enforcement agency in Northern Europe uses their platform specifically to enforce rigorous privacy policies. A financial institution employs Foundry's integrated obfuscation tool. It uses cryptographic guarantees, basically mathematical proofs, ensuring data stays confidential and unaltered. This allows non-technical users to work with sensitive client info securely. Another European customer worked with them to implement technical measures needing reviewable justifications for data access, adhering to strict purpose specification rules. A European telecom used their minimization tool to obscure sensitive data for GDPR compliance. And during the pandemic, their platforms provided a secure, privacy-protective cloud enclave for collaborative COVID-19 research.
Okay, so concrete examples. And who's overseeing this internally?
Well, their team actually includes engineers, lawyers, philosophers, social scientists, a diverse group, and they're further supported by an independent council of advisors on privacy and civil liberties.
So it's not just policy on paper, it's really built into the tech itself.
Yeah.
What are some of those key technical capabilities enabling this privacy by design?
They offer specialized tools for sensitive data discovery and management. Also, oversight and auditability. This includes comprehensive audit logs tracking every single action, data retention and deletion tools, and data provenance. That last one, provenance, is particularly important. It creates a complete, immutable record of all data transformations right from its origin. Ensures reliability and traceability. You can see exactly where data came from and what happened to it.
Okay, so while Palantir presents this picture of rapid innovation, ethical commitment, it's crucial to remember no company operates without headwinds. What are the significant risks? the things that could challenge this trajectory, both operationally and for investors.
Absolutely. And this section is vital for you, the learner, to grasp. Palantir operates in a highly competitive, rapidly changing environment. Competition is fierce. It comes from large enterprise software companies, big government contractors. Many have greater brand recognition, larger budgets, broader offerings. Customers might just prefer sticking with existing providers. Even if Palantir's features seem superior on paper, inertia is powerful.
The nobody gets fired for buying IBM idea, kind of.
Something like that, yeah. And another significant, maybe nuanced risk is customer concentration. Their top 3 customers accounted for 17% of their 2024 revenue. 17%. Now, while these relationships are long-standing, averaging 9 years, for the top 3 customers can reduce spending or terminate contracts for convenience, which basically means they can walk away at any time without cause.
Wow, okay, so even long-term contracts aren't entirely secure.
Not completely guaranteed, no. For instance, their total remaining deal value was $5.4 billion at the end of 2024. But there's absolutely no guarantee they'll realize all of that booked value. Then there are the broader factors. Like many global companies, they're susceptible to geopolitical tensions, higher interest rates, currency fluctuations. Think about the impacts from the ongoing Russia-Ukraine and Israel conflicts. While they state these haven't materially affected their results to date, they represent continuous risks. They definitely influence customer spending decisions.
And technological risks.
Security, yes. They acknowledge inherent risks from errors or bugs in their complex platforms. That's always a possibility. And there's the double-edged sword of relying heavily on third-party cloud providers like AWS and Microsoft Azure. It offers scalability, sure, but it means Palantir's foundational infrastructure is tied to external performance, external costs, external security postures. Cybersecurity incidents, even if they're just perceived incidents, could severely harm their reputation, which is built on trust and security. Their chief information security officer, the CISO, and the board oversee these risks, but vulnerabilities are, by nature, inherent in complex systems.
And the legal landscape, especially around AI now.
That's huge. They're subject to complex and constantly evolving laws. Privacy, data protection, security, and now AI governance, both in the U.S. and internationally. Noncompliance could lead to significant penalties, fines, reputational damage. They also face ongoing legal proceedings, securities, class action lawsuits, derivative lawsuits against officers and directors. These are costly, they divert management attention, even if the ultimate outcome is favorable for the company.
Okay, so operational risks, market risks, legal risks. What about the structure of the company itself? I noticed something about voting power and stock structure.
Yes, that's a critical aspect for investors to consider. Palantir has a multi-class stock structure. Class A, Class B, and Class F common stock. And this setup heavily concentrates voting power with certain stockholders, particularly their founders, Stephen Cohen, Alexander Karp, and Peter Thiel. This structure means they effectively control 49.9999999% of the voting power, almost half, which can impact certain institutional investors' willingness to invest or maybe their inclusion in specific market indices that have governance rules.
So founder control remains very strong.
Very strong. Also, while they have a $1.0 billion share repurchase program with about $936 million remaining at the end of 2024, the company explicitly states there's no guarantee it will actually increase shareholder value. It's authorized, but not mandated. Plus, and this is notable for some investors, they don't expect to pay dividends in the foreseeable future. They're reinvesting for growth.
Okay, that's a lot on the company itself. Now let's shift gears slightly to something absolutely critical for any investor or professional. Understanding insider trading. It's not just theoretical. It has severe real-world consequences. And Palantir's policy seems quite comprehensive.
It is, and this policy is fundamental, really, for maintaining market integrity. It applies to everyone affiliated with the company. Officers, directors, employees, consultants, contractors, everyone. The core rule is elegantly simple, actually. You cannot engage in any transaction involving Palantir securities if you are aware of material non-public information. Full stop.
Yeah, let's break that down. Material non-public information. What counts as material?
Material means information a reasonable investor would consider important when deciding whether to buy or sell the stock. Think about things like financial results before they're announced, major contract wins or losses, significant new product launches, maybe new litigation, a data breach, major personnel changes. Stuff that can move the stock price.
And non-public.
Non-public just means it hasn't been widely disclosed to the general public, and the public hasn't had a reasonable chance to absorb it. The policy basically says, Assume information is non-public unless you've seen it officially released through proper channels, like a press release or an SEC filing.
Okay, so it's not just about information on Palantir itself, but also sensitive info you might learn about their customers or suppliers
Mhm.
or even competitors through your role there.
Precisely. That's a crucial point. The policy explicitly extends to material non-public information you might acquire about another company through your work at Palantir. If you gain that kind of insight, maybe about a pending partnership or a customer's financial trouble, you are also prohibited from trading in that other company's securities based on that info. This is really important for anyone operating within the broader tech ecosystem, where information flows between partners and competitors constantly.
Right. So what are the boundaries for trading then? Can insiders just buy or sell whenever they feel like it, assuming they don't have specific inside info at that moment?
No, absolutely not. There are structural limits, too. You may only trade Palantir securities during an open trading window, which the company formally announces. Outside of these windows, there are regular quarterly blackout periods. These typically surround earnings releases when lots of people might have sensitive information. And they can also institute special blackout periods for specific events, like anticipating a major acquisition or some other significant news.
And are there specific types of trades that are just off limits?
Yes. The policy specifically prohibits short sales. That's selling borrowed stock hoping the price will fall. It's seen as betting against the company. It also prohibits derivative securities or hedging transactions related to Palantir stock other than standard compensatory awards like stock options. Derivatives are financial instruments whose value depends on the stock price, and hedging is basically trying to offset risk. These are generally seen as speculative or potentially misaligned with long-term shareholder interests when done by insiders.
Okay. Now, this next point seems particularly compelling, especially for executives or directors who might frequently have access to sensitive information. What if you want to regularly sell some stock, maybe for diversification or financial planning, but need to avoid these complex rules and potential accusations? I've heard of 10b5-1 plans.
Ah, yes, the Rule 10b5-1 plan. This is a really crucial exception, especially for executives. It provides what's called an affirmative defense, essentially a legal safe harbor against insider trading allegations. The key is this. You establish a pre-scheduled trading plan at a time when you possess no material, non-public information. So you set up the rules in advance. Sell X shares on the 15th of every month, or sell Y shares when the price hits Z dollars, unquote. Once this plan is properly set up and approved by the company, transactions made under this plan are permitted even if you later become aware of material non-public information, or if a blackout period is in effect later on, because the decision to trade was made before you got the inside info, right? It removes the element of intent for trading on that information. It's a very powerful tool for compliant trading, and the policy states that directors and executives are strongly encouraged to use these plans.
Right. It automates the trading based on preset conditions, removing the problematic decision-making timing.
Exactly.
And finally, what happens if someone does violate this policy? The implications sound pretty severe.
They absolutely are. The consequences can range from internal disciplinary action, including immediate termination of employment, all the way up to severe civil and criminal penalties imposed by regulators like the SEC. These can include disgorging profits, meaning giving back any money made illegally, paying substantial fines, potentially multiples of the profit gained or loss avoided, and even serving jail time in serious cases. And what's really important for you, the listener, to understand is that liability isn't just limited to the individual who trades. Both the individual and potentially the company itself or even their direct supervisors could be held liable if controls were inadequate. It has broad ramifications.
Wow. What an incredibly detailed deep dive we've had. We've really peeled back the layers on Palantir. Their powerful AI platforms, those ambitious growth strategies targeting really complex challenges, their surprising and seemingly deeply embedded commitment to privacy by design, and the intricate financial and legal landscape they're navigating. Plus, those crucial insights from their insider trading policy, really, a critical lesson applicable far beyond just Palantir.
Absolutely. And if we try to connect this to the bigger picture, Palantir's journey, their story, it's really a microcosm, isn't it? A microcosm of this rapidly evolving relationship between advanced technology, massive data sets, and these deeply human concerns. Privacy, ethics, governance. The challenges they face balancing cutting-edge innovation with responsible deployment, operating globally, dealing with strict regulations. These are challenges that will increasingly define the future for, well, for all of us. It really makes you think, doesn't it, about whether the companies building the world's most powerful data tools can truly embed human values at their core, and ultimately what that really means for the future of information itself.